What's going on, folks? Again, we've got an absolute massacre in after-hours trading here with Stitch Fix. We're talking about Stitch Fix earnings today, as you might be privy to. Nearly a 20% downward movement in after hours. Isn't that pretty wild? Anyone else think that's wild? Down 18.89%. Yeah, it's pretty significant, especially when you weigh on the fact that over the last year, this stock is down 77%. And when we're talking about from their highs, this stock's down nearly 90%. This is absolutely wild. It's obviously at its 52-week low right now. Seemingly just crazy how it's fallen so much to below levels you saw back in 2019. These are the lowest levels the stock has ever been at. So that would obviously assume, you might be able to assume this was a disastrous earnings that would have led to this, followed by just a bad momentum spree for them. Honestly, there's just a lot of negative momentum for Stitch Fix. But let's look at these earnings, then we'll talk about this stock, what we're doing with it. So GAAP EPS line of negative 28 cents, beats by 2 cents. Again, this is not a company that is it's not a profitable company, understandable, for sure. So not terrible, but they did beat just slightly, so nothing crazy there. The revenue line came in at $516 million, up 2.5% year over year, beats by 2.2 million. Not significant by any means. It's not a massive beat, nor is it a massive year-over-year growth. And I think that's where a lot of the concern has come. This is a stock that used to trade at a very high multiple. We used to see, the double-digit revenue growth lines, but here seeing a 2% revenue growth isn't necessarily exciting for people. So I get that. Active clients did come in at 4 million, increase of 146,000, or 4% year over year. That's still good, and again, the revenue will be kind of in line with that. Quite a lot of active clients, though, all things considered. Net revenue per active client increased 18% year over year to $549. I think that is a significant line when you talk about the future of it, because obviously growing revenue per client is a great way to bolster sales in the future. And a $549 line is pretty significant, if you ask me. It's pretty nice. As far as outlook, now this is where we get into the massacre, okay? Quarter 3 outlook looks like they're expecting 485 to 500 million versus a 558 million consensus from the analysts. Massively under expectations. That is where we see the massacre, okay? Absolutely. And adjusted EBITDA of negative 30 to negative 25 million. Nothing crazy there. But this as well here. For the full year, expecting revenue to be flat to slightly down year over year. Now that is cause for massacre. The potential of even declining sales year over year leads, obviously, investors to be running away from the stock in droves. Reaction, pretty negative towards the stock. Everyone's negative towards the stock if you look on Seeking Alpha, which is, understandable given previous performance and the company not doing much to excite people. Okay, I get that. I do. So let's look at the press release, see what nuggets we can dig out here. Okay. We obviously saw this line. Net loss came in at $30.9 million. Not crazy when you're talking about a net revenue line of $516 million. Not that bad a net loss. But the adjusted EBITDA came in at $10.1 million. So, positive news there. Business performance, they delivered the quarter we largely expected. How's that exciting? That's just a very boring line to say. We expected it. That's not really a business performance highlight. I wouldn't mention that. Positive trends in client engagement, revenue per active client, obviously reading record high as we saw. Freestyle revenue grew 29% year over year. And as they say, they're observing challenges with onboarding and conversion of clients and are beginning to direct new clients to a clear and easy Fix onboarding path. I get it. They're trying to get more users on there, and they're struggling, is what they're saying. guidance was rough. So from them, specifically why this guidance is the way it is, given the number, the softness in the number of active clients in the first half of the fiscal year 2022, and the uncertainty in the timing of improvements in conversion, we are lowering the prior full year revenue outlook we shared back in December. Not good. So they're saying basically because they're at this point struggling to convert people into regular clients, they are lowering all of this. 10 to 7% decline year over year. Really hate to see that. What else do we have to look at? Well, we have a balance sheet to look at. Very, very bare bones in terms of the press release here. We can take a look at the presentation, see if there's anything exciting on there as well. But for now, we'll look at this. Total current assets coming in at 531 million compared to 6 months ago at 521. Not a significant change there, all things considered. Total assets in general at 898 compared to 819 million. There's growth there for sure. Most of it seemingly in this operating lease right of use assets. Okay. Now from a liability standpoint, total current liabilities saw a increase 276 compared to 228, and total liabilities in general 437 compared to 358. Now this isn't a company that has an incredible amount of long-term debt, so that is honestly a positive for them when you compare it to assets. The balance sheet's in actually really good shape for this company. Has increased over the last 6 months just slightly, 461 compared to 460. Really, it's only a difference of $200 million, so it's not massive over the last 6 months, but the balance sheet got a little bit larger, and there's good things to talk about there. There really are. But look, that's all I can say is look. I mean, nothing super exciting. Let's look at the investor presentation. I'm going to see if there's anything super exciting. And again, they're selling the business here. Founded in 2011. I get it. I understand. What can we say? So, based off of the market here, the total market here currently, as they say, in terms of apparel, footwear, and apparel accessories, right now sitting at $434 billion for the U.S. and UK. Apparently expected to be by 2026 at $543.8 billion. Quite a massive increase, and online penetration is expected to increase quite a large margin as well. Annualized growth rate being around 9%. And this is a theory I do agree with. Look, there's a lot of negativity with this company right now, but I do 100% agree with this. We're going to see continued trends in online e-commerce growth, and no one's to say that Stitch Fix is going to capitalize on that, but they are one of the top players in the sense that they're strictly an online retailer, okay? That's something you have to consider there. So, personalization model, obviously, as they mentioned, they're basically using your info and what you've looked at to find really what they believe is going to be a good fit for you, whether it be branding, or just style. So that's something you can consider on that. So obviously data matters. They care about where you're at. They care about what you buy. I mean, they do have an actual decent algorithm here as far as that's concerned to find out what you like. I mean, everything they kind of take everything into effect there. So something to consider as well. And supposedly here, the algorithm, 63% match score on the algorithm, so people are liking the algorithm for the most part, and it's turning into converted sales, so that's a positive number for them. It really is. So goal, obviously, reaching the total addressable market, new clients. I get it. Boring stuff there. Very boring stuff. So financial model, as you can see here, from a revenue perspective, last year was a massive year for them in terms of growth in comparison to previous years, and that's why they're kind of expecting a decline this year, which is quite negative, all things considered. Active clients showing growth, good to see in that aspect. Revenue, there's growth there. Not a massive line here, but net revenue per active client grew quite massively when you look year over year. Again, you see 467 compared to 549. So they're making more of the clients they have right now, which is really important for them. Long-term growth, again, advertising, they're doing less advertising, which I don't know if they're ready to do that quite yet, because I mean they're a popular brand, but not necessarily one that I don't think needs advertising yet. So just throwing that one out there. And this was obviously one of the first quarters of non-GAAP profitability. Good to see when you look year over year. I mean, there's a significant difference there, but it's non-GAAP profitability. Would like to see them get to GAAP profitability. I mean, that's kind of about it as far as this presentation. What do I think about the stock? Look, this is a company right now. Ridiculous how cheap they're trading, right? Ridiculous. This company is trading under a $1 billion market cap after this move, depending on where it sits at in the morning. Just to put that into perspective, this company made $2.1 billion last year, trading in a market cap under $1 billion. Price to sales under 0.5. I mean, there's no doubt this is an absolute dirt cheap stock, right, in terms of valuation. Now, what determines if it's a buy or not is whether you think they can capitalize on the future growth of online retail. I frankly think they do. I hate to say it because a lot of people are really negative on this thing right now, but and maybe it's because I've been riding, Stitch Fix really since $20 over on this side, or I think it was around 18 is my cost basis. I rode it all the way up to over 100, and guess what? I didn't sell it, unfortunately, and I've ridden it all the way down now to 11. I do plan on adding more. Anything under 10, I think, is a ridiculous steal for this company. I think regardless, it's going to reach around $20. I mean, this thing's going to recover within the next year, in my opinion. Not to the $100 level, I don't think, but it will, I think, return to at least a price to sales closer to 1. I think it's deserving of that. I really do. Hyper growth isn't there, but it's just the unfortunate timing of the market absolutely clobbering these stocks that took off last year, absolutely clobbering them. So, or the year prior, I should say. So great time in the market, obviously, as you can see. But that's what I got for you. I hope you have a great day.